What's up, everyone? And look at this chart. The Bank of Canada just raised rates by 0.75%. Well, hold on. Let me rephrase that. The Bank of Canada just raised rates by 0.75% in July, but they've held steady ever since. And today is no different. They are holding steady as they continue to assess the impact of their 450 basis point rate hike from July to January. In other words, they want to see how much damage they've done already before deciding whether or not to do more damage. Now, let's be clear. It's not that they don't want to raise rates anymore, it's just that they want to take it easy for a while and see how things play out. And honestly, who can blame them? The Canadian economy has slowed dramatically as the housing market has gone from red hot to ice cold. In fact, according to this new data from the Canadian Real Estate Association, home sales plunged by nearly 30% year over year. That's the biggest decline since the start of the pandemic. And this is exactly what we would expect to see when the cost of financing a home goes from this to this. When mortgage rates double, obviously demand for housing goes down. But there's good news and bad news with that. The bad news is that home prices have been falling for 6 straight months. The good news is that this means that buyers have more purchasing power than they did a year ago. So while it may be painful to see your neighbor's house go from a $900,000 listing price to $750,000, the silver lining is that now you might be able to afford that house. So what does this mean for the Bank of Canada? Well, let us go back to their most recent rate decision from January, where they raised rates by 0.5% and signaled that more rate hikes were coming. However, they also said that they would be watching incoming data closely to help guide future decisions. And boy, have they been watching that data closely, because ever since then, the Canadian economy has rapidly For example, GDP fell by an annualized 3.4% in December, which was worse than expected. And even though the first 2 months of this year were revised higher, the Canadian economy still hasn't recovered to pre-COVID levels. In fact, the only reason why GDP looks so strong in January and February is because of a statistical quirk where the numbers get revised higher after the initial data comes in low. But if we look past these revisions and look at the trend, we can see that the Canadian economy is still struggling. Not to mention the fact that inflation has already started to come down. We know that January CPI came in cooler than expected, but we also have wage growth data that suggests that inflation is starting to cool. Because if we look at this chart from Zero Hedge, we can see that wage growth is starting to slow down. And if wages grow slower, then that means workers have less disposable income to spend, which means less demand for goods and services, which ultimately means lower inflation. So given that the Canadian economy is still struggling, inflation is already starting to come down, and global uncertainty is growing, the Bank of Canada doesn't have to rush to raise rates further. And frankly, they shouldn't. We've seen time and time again that central banks that move to quickly break their economies. And unfortunately, the Bank of Canada isn't any different. After all, their mandate is to keep inflation at 2% while keeping the economy strong. And right now, the economy is sending out some pretty big warning signs. For example, retail sales have fallen for 5 straight months in a row. Consumer confidence is collapsing, and manufacturing is already in a recession. If the Bank of Canada wants to avoid causing a deep recession, they need to tread very carefully. Personally, I don't think they need to raise rates any further, but I wouldn't be surprised if they hike by another 25 basis points in March. That way, they can say that they're still committed to fighting inflation, but they're also giving the economy some time to recover. And that's why the neutral rate of interest is such a dangerous thing. Once you cross that line, you lose the ability to cut rates to stimulate the economy. So the Bank of Canada needs to be very careful here. Luckily, they have plenty of time to figure it out, because inflation is already starting to cool. With that said, you guys, thank you so much for watching. And always remember, you are the reason why we're able to do what we do every single day. So with that said, until next time,